Welcome to the Treasury Update Podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome back to the Treasury Update Podcast, Becoming a Treasurer series, talking about the languages of finance. I'll be your host for today's show, Jason Campbell, Business Development Leader here at Strategic Treasurer. And chatting with me today is Craig Jeffery, Managing Partner at Strategic Treasurer. Craig, glad to have you on today.
It's good to be on again.
I think our last episode was great. I was thinking about when we were talking about accounts payable, think about a Twix bar. And the reason I was thinking about Twix bars is because I think about like AP and AR being a Twix bar, right? And we just pulled it apart and we talked about left Twix, right? Which is that accounts payable. So we did that episode. It was great. I thought we had some really good dialogue. Now we're going to talk about the right Twix bar. And I am not paid by Twix to mention Twix on this podcast, but we're going to talk about the right Twix here. And in this Becoming a Treasurer series, talking about the accounts receivable, we covered FP&A, we talked about controllers, definitely had a great conversation around accounts payable, now moving to accounts receivable, because now that we paid vendors, now as being somebody who works in accounts receivable and looking at saying, hey, now my job is to bring in the cash, right? So let's talk about this. But before we get into the function of accounts receivable, explain again the purpose of the languages of finance subseries, if you don't mind.
I think it's to relate everything to a candy analogy. When you were saying Twix, I kept thinking that tricks are for kids, Twix are for kids, and I don't know, I just got off on that. So
both are equally good, though. I mean,
I'll take your word for it. I think I remember Twix candies, but what's the purpose of this? I mean, the idea that there's words and terms that different people use in an organization, and motivations, and good communication and effective working relationships means understanding the other. So that's really the genesis and the continuation of all this.
Yeah, well, I think and hopefully our listeners will agree to this too as well. I think you've given them some great words of wisdom in each of this as they look for, what do careers look like in the world of Treasury, and really the episodes prior to this. I mean, we dived in, maybe a little high level overview on some of these, but I thought there was some great content around, some good forward thinking. And coming back to this, how is the language of accounts receivable though different from Treasury?
Yeah. So, the language and the priorities can differ in a number of ways, and probably the biggest area has to do with priorities. So we can talk about days sales outstanding, the average number of days worth of receivables are outstanding. That's a key measure, for example, for the accounts receivable group. Treasury cares about working capital. That's a key metric for that. It's easy to capture because it comes from the financial statements. Right, you take it at the end of the month. Now, the problem with that is if you're in accounts receivable, is you just focus on making sure everything's collected by the end of the month because the snapshot's coming at the end of the month. Right, the balance sheet is as at. It's not for the period ending. It's as of a particular period. So they're looking at the snapshot there. And their measurement about how they're collecting is at the end of the month. Well, that's not necessarily the best way to handle cash flow. It certainly gives some measure, consistent. It's easy. It's in the financial statements, but that doesn't get you everything you need from a Treasury perspective. You need cash every day in Treasury. You can't just say, how does cash look at the end of the month? How low is receivables? How much cash is being absorbed in the accounts receivable process at the end of the month? There's quite a few other days in the month, 27 to 31 other days. So that's one. The other has to do with, accounts receivable. If they care about, posting to receivables and reducing that, the key thing for them is posting it in the accounts receivable subledger or in the GL, depending on how you're phrasing it. So when they get receipt or notification that they've been paid, it could be an ACH, it could be some other notification that payment's coming, or it could even be a check, right? Maybe they even got a check at their desk if that is still a thing. But the idea is when they relieve the receivable, that adjusts what they have. And if they can relieve the receivable before the end of the month, their total receivable goes down, whether or not those funds are actually available, if they're liquid to be used by Treasury. So some of that float has been driven out as we moved away from some of the worst processes with paper. But you can still have that in a month. Paper items can come into a lockbox, or items with multiple days of float can be received. What's being paid for, and you can adjust those on the AR system or on the general ledger, converting those to cash, even though it's not liquid. So that's a secondary. So DSO is a snapshot at the end of the month, and then collected funds. Now, the other thing on some of the different terms, applied versus collected, those are terms that Treasury uses, as does accounts receivable. So if you receive some type of payment, someone sends you an electronic transfer into the bank account, and so AR sees this $22 million, $220,000 payment coming into the account for a particular company. They can assign it to a customer because they know who it is, and then the application process is clearing the individual invoices. Well, let's say the records weren't clear, or they didn't send the details. So they have this $220,000 receivable. They assign it to the customer, but it's not applied to the individual invoice level. There's a whole range of things that can happen depending on how the company is set up. AR is going to be very concerned about getting it applied to the invoice level. Treasury wants to know what can they expect in the future, information about the forecast. They want to make sure they can use all the funds, which they probably will from the bank perspective. But there can be some differences there on the assignment and application level. So those are some of the differences. The other one, if I could just keep rambling on for
absolutely
5 minutes without stopping, is AP. Accounts receivable. I know we talked about AP the other day. Receiving payments is oftentimes you're the one receiving payments. You're selling. You want your customers to pay you however they want. You might have preferences, but you're usually accepting different kinds of electronic methods, maybe wire transfer, maybe different kinds of card. You may not care so much about the different methods and how they matter from a cost perspective or from a working capital perspective. Treasury always cares about those things. AR may care about certain aspects of that. Does it help us be efficient? As long as there's no problems, they would push people to processes are more efficient for them, not necessarily on an overall cost or total cost of a business process perspective. So those are some areas where getting together on those matters.
Again, you mentioned some great points when it talked about, again, understanding each role and which function, right? Because sometimes you can be narrow-minded too as well, because your priorities are different, right? And what Treasury is trying to achieve and what accounts receivable. If my job is to be able to collect and categorize on the balance sheet where things need to go and ensuring that invoices are marked where they need to be marked, or where the funds are coming in, and to ensure that we're aligning it correctly. I mean, it's pretty hefty to think about. That's what your job function is, and not knowing, hey, somebody else is looking for that money to come in to do with what is it really funding? What is it trying to be pulled to do, right? So I could see where definitely there's those differences between the two. So as we think about understanding those differences, now let's go into what are the problems with misunderstanding each other? I think you kind of talked a little bit about it, but let's go in a little bit deeper.
Well, the two key areas would be related to process, and the other, access to working capital. I think we talked about some of the areas on the working capital, the DSO snapshot, different metrics of what are used, and Treasury needs available funds. AR needs to target what occurs at the end of the month. In most groups, there's good communication between Treasury and accounts receivable. Give us your forecast. What are you going to be able to collect by the end of the month? And even sometimes it's, we need to hit this number, dial for dollars, put pressure to get those things in by the end of the month. And AR groups are really good about pushing and collecting enough funds so that they can hit the forecast and the target that exists. And so that's a good example of communication and cooperation, across the board. Other ways about misunderstanding. The other part of that, just like the organization can offer, early pay discount, 2% net 30, for example, or 1% net 30, whatever the particular terms are. Those can help an organization collect funds sooner. That's used by AR groups to push people to get a lower price on things, essentially by paying quickly, paying within 10 days or 15 days. But it's also pretty inconsistent. A smaller percentage of companies can pay earlier or want to pay earlier, can pay earlier because maybe it's a capital issue, or a liquidity issue, or it can be their approval process is slow and inefficient. And so by the time they get it approved, it's 25 days. And if the terms are net 30, they're not going to pay 5 days early because there's no discount. Understanding what the organization is trying to do matters. And so things like some of the supply chain finance options and what we consider also supply chain finance dynamic discounting is a way of, here's a sliding scale. Oh, you got it approved in 20 days? You still want to get this discount? It's not as much as it was if you got it approved in 10 days, but you can still get a discount off of the invoice. And for a larger percentage of organizations are like, okay, this works for us. We have enough cash. This gives us a discount on our cost of goods sold. We're going to pay this early. This makes sense. So that helps the organization leverage early pay discounts or dynamic discounting to pull in more cash across the board. And that may be a key financing lever that the organization is using to accomplish it. The Treasury wants to use to do that. So coordination between those two is quite vital. What are the key drivers? I know we've talked about these. Treasury focuses on working capital liquidity. They also don't want fraud. Accounts receivable is focused on efficiency and accuracy, right? Posting these things right away. Where can AR get in trouble? Well, we didn't clear the receivable, and now a shipment has been held up. Okay, that's the credit group is like, we haven't received payment. Here's an issue. So rapidly posting these items so they can be cleared, so more goods can be shipped and more services can be delivered. That ties into efficiency and a well-designed process. So not understanding some of the key drivers or differences between those areas may result in a process that's broken to some extent or to a large extent, which means interruption to your customers because you've held up a shipment, delays in posting and receiving funds, or even further downstream. I know we've talked about reconciliation before. If you've made a process or using a process where you change the timing, you've changed from a gross to a net, let's say using cards on receivables and things are settling on a net basis and you're posting in your point of sale system as on a gross basis, and maybe the cutoffs are different, so your daily totals don't match. You can create all these kinds of issues where there's a mismatch. And so those are some of the problems with misunderstanding. Most of them are not terms per se, but thinking about the process. And that's a misunderstanding of the process and not paying attention. If I don't know what you do, you must be doing something really simply. That's obviously false. So the idea is, hey, we need to understand what's going on. How can we meet all of the goals together?
It's like I remember going one time to this is just a personal story. And I remember going to it was a hospital bill. I was going in for a procedure or something of that nature, and it was one of those. You always have to have a discussion with the cashier, or the finance manager of the hospital or whatever, right? And you go into this little cubicle as I sit down, all right, we got your insurance, and we looked at okay, here's your deductible, and your payments, and how are you going to pay for this? But you'd always get a deal, right? They look at you and say, but if you can do this by this day or today, we'll knock off X amount of percentage, a percentage, whatever it is, the discount, to come to terms versus being on a payment plan or being whatever, and as we were talking about that, that's just an example of something that just popped in my mind. Because I don't know if you've ever experienced that or not, but it happened.
I haven't had to go to the hospital. So, but I mean, you told me about your Twix removal surgery, so I can understand how they want to get paid soon. Yeah,
but it makes sense. It totally makes sense. It's always good. I think that being incentivized, and I think dangling a carrot where you can best benefit, and based off what your department, your organization, or however whatever the goals are. So we talked about a little bit about the problems of misunderstanding. So again, let's flip the script here and look at it. When do AR and Treasury groups need to really come together and find a way to have peace and harmony?
I think it's pretty easy for either group to make the other's life very miserable, across the board. So, Treasury is going to care about their banking relationships primarily. to make sure that they have credit, access to credit. AR as a group, as well as sales, is going to care about the client relationship and experience, because that will help them sell more. And I think understanding those two areas, they need to work together, because you have to feed your banks that provide credit ideas, long-term relationship, and you have to support your customers, your clients. Those two things have to be done together. So that's a working together. Even though one is more oriented towards one than the other, both of those are important to the organization. And that ties into the working capital management. I'll talk about that all the time. Your cash conversions, like how efficient it is, but actually not having too much tied up in receivables as one key area. If we're talking about receivables, if we're talking about sales, there's a whole other thing about sales and treasury, which I guess that'll be another one of our talks about the different languages. But the other piece too is they need to work together on the process, and that includes all the way through to reconciliation. They apply, assign, auto apply functions that help AR move to the process where they're only dealing with the more thorny issues is great, because they have to be efficient. And so you have to have the right types of services that allow AR to scale and handle differences in volumes, right? Work doesn't come into AR on a consistent basis throughout the month in almost every organization. It's got peaks, it's got middle of the month, end of the month, double barbells, whatever they have uneven workload, and they have to post and manage this activity. To the extent that Treasury can help bring services and functions to them, their ability to work together allows for a far more scalable accounts receivable group. That means a far more even flow of cash, be able to support it. And efficiency is a key driver for all of them, because the organization has to be able to scale properly. Those are some of the key areas.
Well, I think it's, as anything, organization wise, even though they're like cousins, right? You got to find ways to make it work, and showing up at the family reunion and all the good stuff to play nice and to find ways to work together and share some of those commonalities, and ultimately having the objectives met at the end. Well, Craig, thank you again for joining me today. Really do appreciate it on this episode of Becoming a Treasurer, talking about accounts receivable. And thank you to our listeners for tuning in to this episode. Really hope, again, there were some great insights and key things that maybe you were able to take away and be able to advance your next career step. So until next time, take care.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.